Can this man create value, or is he the problem? Brian Roberts has run Comcast since 1990. In September 2021, Comcast stock hit all-time high. Today, it's trading down more than a half, while the S&P 500 more than doubled. Roberts saw the threats coming, fiber, wireless, streaming, but he was slow to react. Now he's splitting the company in two. Is it a real fix? Or is it too small and too late? In this video, we find out whether there's still value hidden inside Comcast or whether investors should walk away. So what is actually the problem? Let's start with the core business, broadband. Comcast is losing customers, roughly doubling year after year. Why is Comcast losing customers? It's getting squeezed from both sides. On one side, we have T-Mobile and Verizon who are selling cheap wireless home internet. No hassle. On the other side, fiber is rolling out fast. Cheap wireless is stealing the budget customers. Fiber is stealing the customers who want speed. And Comcast is stuck in the middle, running on cable lines built decades ago. Normally, when the stock gets this cheap, private investors buy the whole company. That never happened with Comcast. And the reason is they're too big. But size isn't the only problem. There's a conglomerate discount at play. Investors don't know how to value a company that owns too many different businesses. That's exactly why Comcast just announced it's splitting itself in two. And here's the crazy part. Roberts owns less than 1% of Comcast stock, but he holds special shares that gives him 33% of the votes. Even activist investors can't push him around. Nelson Peltz tried in 2020, pushed for a breakup, but that never happened. So Roberts did it himself. So Company 1, which is Comcast, Xfinity. Company 2 is NBCUniversal, the entertainment business. It includes Peacock, NBC and Telemundo. They also own Sky, and then they have Universal theme parks. The core reason Comcast is splitting in two is simple. Media and broadband used to make sense together, now they don't. Each business faces totally different competition, and Roberts says separating them lets both move faster and focus harder on what they're actually good at. The split should be done in about a year, by mid-2027. Comcast stock jumped up over 20% at one point. Investors started betting that Comcast Charter merger could be next. Robert pushed back on that idea. He told reporters that the split is about giving each business more focus, not setting up a deal. And then the stock plunged again. Now let's look at what each piece is actually worth. Quick disclaimer, I'm not a financial advisor. Do your own research. Let's value each piece. First, Comcast. EBITDA was 32.4 billion last year. At Charter's average multiple of last 5 years, which is about 6.8 times, we get a value of 221 billion. Then we have NBCUniversal. EBITDA was 6.5 billion. For the low case, I'm using Warner Brothers Discovery, 7.5 times EBITDA, which gives us about 49 billion. On the high case, I'm using Disney's multiple, about 13 times, which gives us 85 billion. Add both pieces together, and Comcast enterprise value ranges from about 195 billion on the low end to 306 billion on the high end. Subtract the netto debt of 85 billion, divide by 3.6 billion shares outstanding, and you get $30 to $61 per share. When we look at the free cash flow, this jumped to 21.9 billion in 2025, up from about 15.5 to 16 billion the 2 years before. Some of that jump came from a one-time investment gain, so I'm using the 15 to 60 billion dollar range. That gives us a free cash flow yield between 17 to 19%. The dividend yield is 5.5%. When we look at the interest that Comcast pays yearly, right now it's about 4.4 billion a year in interest, an average rate of 4.5%. Now here's the crazy part. Look at their actual debt list. Some notes were borrowed years ago at a rate as low as 0.25%, back when the interest rates were near zero. Newer notes carry rates above 5%. 25 billion comes due in the next 5 years. They have to refinance it at whatever the market rate is. Interest rates are already above 5%, and every extra dollar that goes in interest is a dollar that doesn't go to free cash flow. This can be a real problem. Is Comcast actually a bad business? I think no. I was rewatching the Real Iceman podcast. Wireless has a hard limit. Cell towers can only handle so much. Wireless home internet can never reach more than about 25% of the homes in the US. Real data backs that up. The other 75% is a fight between fiber and cable, and they are closer than people think. And I know this from first hand. I used to work at a cable company which was owned by Liberty Global. Most fiber companies only run fiber to a box near your house. The last part to your home still uses regular cable. So fiber internet and cable internet aren't as different as ads makes them sound. And that's so interesting because on the podcast they said that the rest of the market splits about 50-50 between fiber companies and cable companies like Comcast. Fiber companies can bundle internet and cell phone plans, but what they can't easily do is bundle live television and streaming because they don't own the content. And Comcast still can, for now. And here's the part that caught my attention. Someone could actually buy Comcast now when they split up the company. So here's what it comes down to. Xfinity is still number one, the biggest internet company in the US by customers. And in the newest test, Comcast network beat the others in speed and quality. Comcast isn't losing because of bad tech, it's losing the pricing and market fight. When we look at the return on capital, using Joe Greenblatt's method, Comcast comes out at about 35%. Comcast is priced like something is badly wrong, but when we look at the free cash flow, then currently it looks like a good business. You only pay 4.4 times what it earns, but there's a real problem, and that's the debt. And that's why time is not on our side. The sooner this split happens, the better. And that's the risky part. Comcast could push the timeline back or even cancel the split altogether. That's a real risk. I wouldn't be surprised if private equity would buy the cable company. And maybe there's also another company who likes to own NBCUniversal. Recently, we saw Netflix and Paramount fighting over Warner Brothers Discovery. Here's how I would play it. Because of the debt problem, I would only take a small position and I would buy this for the value that hopefully will be released. So basically, short, get in, get the value, get out. If this video was helpful, just let me know in the comments.